I'm Michael Fox, and this is the Prospector News Podcast. And I have joining me regular guest and friend Jeffrey Christian, the managing partner of the CPM Group. Welcome, Jeffrey.
Yeah, it's good to be back with you, Michael. I hope everything's going well for you.
Yes, it has. We've been trying to get this teed up since we saw each other in New York back in May at the SME event there that we got to spend a little bit of time with each other there. Happy to have you on. And I wanted to have a discussion about the silver market because I see a lot of people talking about a lot of things about the silver market, but the silver market isn't doing what they're saying it's doing. And I think I've gotten a handle on exactly why. And I wanted to talk to you about it because at the end of the day, you're the data guy. Math is math. 1 + 1 is always 2. And you can kind of break through the clutter with the data and we can have a proper discussion about these things. So everybody that I've been talking with keeps saying, well, silver should be going up because gold is at all-time highs, and they are puzzled why. And the conclusion that I have come to is a lot of the analysts I see in the silver market treat silver predominantly as a precious metal, very similar to what gold is, when in reality, silver is a hybrid metal. It's got a lot of industrial purposes. And yes, it's used as a precious metal at times, but it's more of an industrial metal like copper would be rather than a precious metal. And these analysts are kind of all on one side of the boat and they're missing the big picture. Have I got that right, Jeff?
Not really. I mean, it's more complex than that. You are correct that, if you look at the silver market, 90% of the physical silver that's being mined and refined from scrap is going into fabricated products. And, you're nice in calling it a hybrid market. I say it's a schizophrenic market. It does have split personality. But I think analysts, we at CPM Group pay a lot of attention to the investment demand for silver. And I think a lot of other analysts do too, because if you look at the silver market and what you find is that while the vast majority of silver, physical silver, is going into fabricated products, the growth or contraction of silver demand for fabrication purposes is relatively what economists would call autocorrelated. And it follows year by year. So the changes year to year are 1%, 3%, 5% up or down. But investment demand is much more volatile, and markets are made at the margin, and the margin of the silver market is investment demand. And if you look at investment demand year to year and how much investors are buying on a net basis, physical metal or not, you're talking about plus or minus 100 million ounces. So the investment demand is much more important in determining the price, because that's the marginal supply or demand. Some years investors sell silver on a net basis, and it's the marginal supply, and that tends to drive the price down. Other years, most years, investors are net buyers of silver, and at least since 2005, and they are the marginal demand. So they determine the price, or their purchases or sales are much more important in determining the price. A company that's using silver, brazing alloys, mirrors, ball bearings, solders, electronic goods, jewelry, silverware, solar panels, a company that's using silver as a raw material in its product pretty much has to buy that silver if it can't substitute away from it, regardless of the price. So year in, year out, that's a stable base of demand for silver, which helps support the silver price. But it's the marginal investor who has total discretion, who can come in as a buyer, come in as a seller, or just not be involved in silver. He has a lot greater influence on changes in the price and levels of the price. So analysts are kind of right to focus on investment demand because that's the price determinant, but you cannot lose sight of the industrial demand because it is big and it's a substantial part of the market.
So what is the industrial demand versus the investment demand on any given year, roughly?
Last year, investors were very down on silver. They were big on gold. You were talking about the gold-silver ratio. Last year, gold and silver prices basically were strong, but investors were far less interested in silver than they had been. So if I go back 2 years to 2021, and the price of silver rose 26%, 24% on an annual average basis in 2021. And in 2021, silver investment demand had spiked up to 113 million ounces. Fabrication demand was 990 million ounces at that time. So, it was 9 times it was 9 times what investment demand was. But it was the fact that investment demand had gone from 38 million ounces in 2019 to 90 million ounces in 2020 to 113 million ounces in 2021. That's what took the price of silver on from $14 in 2019 to as high as $29 in 2021. So during that period of time, as I said, okay, you saw investment demand go from 38 to 113. Go fast forward the next 2 years. In 2022, investment demand was 56 million ounces. And in last year, it may have been only 12 million ounces, right? So very volatile, but also, you could see last year, 12 million ounces in investment demand. Fabrication demand was 970 million ounces. So you see much more metal going into fabrication demand, but it's a less volatile source of demand. So it's really that marginal investment demand or lack thereof that determines whether the price is rising sharply, as it did in 2021 and 2020, or falling 13% on an annual average basis in 2022. And rising a modest 8% in 2023.
So if I'm understanding this correctly, then the reason that everyone's lined up on that side of the ship is that investor demand is what's driving the price and not necessarily the industrial demand. Is that not, you refer to as kind of being a schizophrenic market, but is that not a situation where it's the tail wagging the dog rather than the other way around? And that, the silver price is kind of dependent on, investor sentiment.
Yeah, it is sort of the tail wagging the dog, or as I said, market prices are determined at the marginal supply and demand. And investors are the marginal supply and demand. So this is not unique to silver or to silver and gold. This is the way economic markets work when they're working well, is that marginal supply and demand determine the price. And that's what you're looking at. In terms of, analysts focusing on investment demand, I think most of the analysts in the world are less interested in supply and demand fundamentals. They don't do the physical market research that we do. And what they really are interested in is what's the price of silver. And a lot of analysts who look at silver or gold or copper are actually mining analysts, and they want to know what the price is because they want to know what's the profitability of those mining companies. So I think that, what you're seeing is a lot of analysts are more interested in what the price might do than in actual supply and demand. So they focus on what determines the price, which is investment demand.
Okay, so they're looking at it from a speculator type of purpose where they're looking at how the price of silver is going to affect their other investments in the mining companies.
I think so.
I see. Okay. Well, that would make a lot more sense because, as I say, I keep looking at it, and that's why I see everybody lined up on the same side of the ship. This would be a good time to introduce then the next part of this conversation, which is ratios.
Yeah.
I've looked at it, and everyone wants to talk about the gold silver ratio, the gold silver ratio, the gold silver ratio. And I'm looking at it, and because in my mind, again, silver is predominantly an industrial metal. I often wonder if the better ratio to be looking at is the copper silver ratio, because as copper supply and demand would shift, because it is an industrial metal, that would cause a bigger shift in the silver demand in my mind. However, I guess in price, if what you're telling me is that would actually have a very insignificant. So the question I guess I have for you, which of those ratios should be more important to look at as someone who wants to invest in the space, or should they be looking at both of them or neither?
If I had to vote, I would say neither. But the reality is that, again, from a price determining perspective, the gold silver ratio probably is more important. And it's more important because people look at it, not because it's a better fit for understanding where silver prices might go, but because people look at it, it probably has more dominance in the market and market perceptions of what future silver prices might be than the copper gold ratio. Silver and copper actually do move perhaps in closer sync because of their, copper's an industrial metal. There are people who invest in copper futures and forwards and things like that, but there are very few people who, buy copper cathodes and put them in their garage, as an investment. So it's less of an investment demand. It's a metal. Copper is very much an industrial metal. Silver has this enormous industrial sector. And yes, if we go into a recession, you will see any number of industries cutting back on their silver demand on a temporary basis. You saw that with electronics a few years ago during the lockdown. Or prior to the lockdown. So the relationship between copper and silver is important. And in fact, it's very interesting because if you do some calculations looking at the relationship between silver mine production and various prices, silver mine production is more closely related to and heavily influenced by copper prices than it is by silver prices. And that reflects the fact that, 70% of the world's mine production comes from copper, lead, and zinc and gold mines, as opposed to silver mines. So if you follow the copper price and the copper price rises and it leads to increased copper price for mine production, you're going to see an increase in mine production of silver as a byproduct. So there is this relationship between copper and silver, and it's partly based on the mining, and it's partly based on the fabrication demand and the relationship of fabrication demand for each metal to overall economic conditions. But the gold silver ratio is important only because people pay attention to it. There's no rhyme or reason for it. The ratio has ranged between like 16 to 1 and 120 something to 1 over the last 50 years. So there's no science to where the gold silver ratio ought to be. We look at it because other people look at it, and we look at it because people will say, oh, well, the ratio is 80 to 1. That means that the silver price has to rise. We look at it and we say, oh, the ratio is 80 to 1. And that means that fabrication demand is weaker factor right now, and investment demand for gold is much higher than investment demand for silver, because investors are indeed focusing more on gold than silver right now. And that doesn't mean that they're going to shift to silver and that the ratio will fall to 70-1 or 50-1 or anything else. It simply means right now, where we are economically, investors are focusing more heavily on gold than they are on silver. And silver is being more of an industrial metal or a fabrication metal than it is an investment metal.
So given that, should some of these analysts that have been focused on the gold silver ratio in order to determine price and therefore the value of the mine output, I'm hearing they should actually be focused more on the silver copper ratio, because that will determine what the production in the mines is likely to be, which again affects the bottom line.
It's not so much the copper silver ratio as just the copper price. A good silver market analyst pays a lot of attention to copper, lead, and zinc mine production, and to a lesser extent fabrication demand.
Okay. So when we talk about all these ratios, at the end of the day, they're a correlation. They're correlating the price of gold versus the price of silver, or the other one that we discussed, the price of copper versus the price of silver, and they come up with a ratio. These are correlated, indices and such, but they're not necessarily causal, are they? Just because gold goes up doesn't mean it brings silver with it and the ratio remains a constant. And just because the copper price moves down doesn't mean that the silver price is going to move down, and those relate those. So what are the causal factors that people should pay attention to as it relates to, say, the silver market, and what's going to cause silver to move up or down in as far as supply, demand, and price?
Yeah. Well, yeah. So staying on the ratios for a while, the strong investment demand for gold relative to silver investment demand is a factor. And that's something that you should pay attention to. I don't know if you necessarily have to pay attention to the ratio, but the ratio is sort of an indicator as to what that relative interest level is on the part of investors. In terms of copper, again, it's the copper price. If the copper price stays high, because it's 422 right now, that's a high price. That should lead to increased copper production, which should be reflected in increased mine production of silver too. So that's the factor there. There are a bunch of other relationships or correlations where people misunderstand the difference between correlation and causation. So you'll hear people talk about the correlation between gold and the dollar or silver and the dollar. And there is a correlation. It's not nearly as great as people think. I think with gold and the dollar, it's like 37%. I think it's even lower for silver. Gold and interest rates, silver and interest rates. And we always say you have to understand the causation. Like, to some extent, gold and the dollar and silver aren't rising and falling because one of the others is rising and falling. Gold doesn't necessarily rise because the dollar is falling or vice versa. Right now, you've had a situation for some time where gold and the dollar have been rising for several years together. And that reflects the fact that they are both, the causation for higher gold prices is not the higher gold dollar price, nor vice versa. What they are both doing is there's a third variable, which is the cause of both of them rising. And that third variable is overall economic and political stability and concerns. So you have to look at the causation of each factor's changing in prices. You can find these high correlations, you can find very low correlations, but as you've said to me in the past, correlation doesn't mean causation. So interest rates might be rising or falling, and that may have a correlative effect with gold prices or silver prices, but it doesn't mean that it's the rise or fall in interest rates that's driving gold demand. You've seen interest rates rise over the last several years, and gold has risen with them. Well, interest rates have risen, from 0% to 5%, but the reality is that 5% is still a historically low interest rate level. So that 5% increase is enormous. It hasn't had a negative effect on the overall economy. It has had a drag. It has been a drag on the overall economy, but it hasn't thrown us into a recession over the last 3 years of rising interest rates. And gold prices have been rising, even though interest rates were rising. There haven't been a lot of people who have said, oh, interest rates are rising. Why do I need to own gold? I can earn 5% on a 10-year bond. What they're saying is, okay, it's 5%, but there's 4% inflation, so I got a 1% real return. That's not enough. I want to own gold. Other people are saying, okay, interest rates are rising. That could have deleterious effects on the overall economy. It could have deleterious effects on the dollar and on equity markets and on corporate bonds. Ergo, I want to buy gold and or silver because of that. So you have to understand, what's econometricians talk about the independent variable and the dependent variable. And if you look at the gold models that we've worked on in the past, you might have 7 independent variables all affecting gold prices to different levels of influence. We had one guy who we helped develop econometric models for gold in the 1980s, and he at the time had like 31 independent variables in his gold model. So it's like, what's the independent variable? You may look at the relationship between interest rates and gold, and you can say, oh, well, interest rates are influencing gold prices, and that may be true. But it also may be true that they're both actually dependent variables, and there's a third variable that you're not looking at, which is the independent variable that is influencing both interest rates and gold prices. So, I think a big, and I love the fact that we have statistical models on computers, but the reality is that the availability of those things, people churn out these correlations all the time. And A, they make fundamental mistakes, which I'll get back to in a second. And B, they don't necessarily understand that there could be a third variable that they're not looking at. There are fundamental mistakes in that you have to, economists always talk about comparing apples to apples. If you look at changes in the interest rate, nominal or real, and you compare that to changes in gold prices, that's good. But if you look at interest rate levels, and then you say, well, okay, but what's that done to changes in the gold price? Now you're comparing apples to oranges. You have to compare apples to apples. What's the change in the independent variable, and what's the change in the dependent variable? The other thing, and if you look at it, for example, with interest rates, I know people who are highly respected gold mining analysts and fund managers who say, oh, well, there's like a 38% correlation between interest rates and gold prices. There's not. Because they're looking at apples versus oranges. If you look at changes in real inflation adjusted interest rates versus changes in real inflation adjusted gold prices, the relationship's virtually zero. And that's what you want as a portfolio diversifier. So you have to look at apples to apples for one thing. And then the other thing that is unfortunate is people will play with the scales. So you'll see a chart where you have, even if you're looking at percent change in real interest rates versus percent change in the dollar price of gold, they'll play with the scales so they look like they're highly correlated. But then you say, wait a second, this is a scale of 1 to 10 on this unit, and this is a scale of 1 to 500 on this other unit. And if I put them both on the same scale, there's no correlation here. And you can visually see, no, one does not beget the other.
No, definitely. And if we're looking at these markets, they're actually a lot more complicated than a lot of the people that are analyzing. They have a tendency to oversimplify. And as you say, they could completely miss the causal variable, could they not?
Yes, absolutely.
I'm going to ask another question because I'm a Canadian. We just handed out the Stanley Cup last week. And I look at all these hockey players, and every year they all grow these giant beards because superstition says that if I grow a beard during the playoffs, I'm going to play better hockey. Not a causal relationship; it's a superstition. So when you hear a lot of these analysts that talk about the causal relationships that are causing the movement in gold and silver prices, what are the common superstitions that you're hearing that aren't really causes?
Well, first off, I have to say it's just what kind of crazy world where a Canadian team loses to ice hockey players in Florida. I'm sorry, but that's just really weird.
I haven't checked the stats, but I actually think that the Florida hockey team had more Canadians playing for it than the Canadian hockey team did.
That may well be true. One of the correlations that you always hear is gold trades opposite the dollar. And, again, you just look at a chart, a properly labeled chart, and you see that's not the case. And you have periods of time like the present time are like 78, 79, where gold and the dollar are moving upward together. And that's because the dollar and gold are like the two big, they are considered around the world as the least risky assets. So right now, over the last 3.5 years, you have had increased risk aversion on the part of investors around the world. They have been buying bonds, treasury bonds. They haven't been dumping them, despite what you'll hear. They've been buying US dollars, treasury bonds, gold, and up until last year, silver. And that is the cause. And the correlation has been very positive on the upside, But you'll hear people who say all you need to know is that gold trades against the dollar and the dollar's going to collapse and therefore gold's going to skyrocket. And there are several misperceptions and misunderstandings embedded in that. Another one is all you need to know about gold is inflation. And the correlation over history over the last 50 years, 56 years now of free gold prices, the correlation is something like 9%. And you can break down periods of time when inflation is over 7%. You have to go back to the 70s to do that. And they had a very high correlation with gold. But you can find other periods of time where gold prices were rising and inflation was bumping along at 1 or 2%. So, that's another misperception that you see. Those are probably the two biggest ones that I hear all the time. The gold silver ratio obviously is the third one, to bring it back around to that. Yeah, those are probably the three biggest ones. There's a lot of other things. Somebody commented on one of our YouTubes last week, how is it possible that COMEX reported silver inventories have gone from 267 million ounces, 4 years ago when the Wall Street silver people were saying that the COMEX was running out of silver, to 297 now. And, the answer is, well, they were wrong. They didn't know what they were talking about. They knew they didn't know what they were talking about. They were trying to, fool investors into buying silver for really weird reasons. The fact of the matter that COMEX silver price inventories are 30 million ounces higher today than they were 4 years ago reflects the fact that you've had weak investment demand, and you've actually had, despite what the silver promoters tell you, you've actually had investors selling silver at times over the last few years. So, that's not necessarily a ratio or a correlation, but there's just so much misinformation that's floating around these markets.
So let's talk about how an investor can actually follow your research. And I guess the easiest, the most simple way for them to do is to buy your gold and silver yearbooks that come out on an annual basis. How would they go about getting their hands on a copy of those?
Yeah, so www.cpmgroup.com. You can get a lot of free reads. You get links to our videos that we do, to speeches that we give, to briefings, and you can buy our books. The gold, silver, and platinum yearbooks are $160 each. They're ebooks, so you buy them and download them and you have them. And they're the basic texts. I mean, these things are like 200, 250 pages long, mostly tables and charts, so you don't have to get too scared about reading that much. But these are basic data that we collect around the world, that we've collected around the world for half a century, or, including CPM Group's predecessor companies back to the late 60s, early 70s. Basic data, basic analysis, and some information about where we think the markets are going. The yearbooks project supply and demand for the current year. We have longer term reports, and we have a variety of ways that we provide clients with information as either consultants or buying. We have a monthly precious metals advisory, which covers gold, silver, platinum, palladium, and rhodium. And every month we update what our market view is with projections going out 2 years on a quarterly basis and 3 months on a monthly basis. So those are the easiest ways to keep track of what we're thinking about the markets.
Yeah, the gold and silver books are out already, and coming up here, actually within a couple of weeks, you're going to be launching the platinum yearbook, and there's a platinum seminar attached to that launch, is there not?
Yes, it's 2 weeks from today, so it's the 16th of July, Tuesday. There'll be an online briefing where we'll present the main conclusions of our 2024 Platinum Group Metals Yearbook. That will be free webinar online, and then people can pre-order the book now, or they can order the book later.
I will put links to ordering books on the bottom of the description of this podcast, as well as the link to attend that seminar. It's free if you want to know about the platinum and palladium and rhodium markets. I've attended this seminar in past years, and it's an excellent source of information. And there's another market that's constantly changing, and it's a good one for you to keep an eye on, because it draws bigger pictures of the overall economy. So I want to thank you for joining me, Jeff, and it's been an absolute pleasure, and I look forward to us having more of these discussions.
Well, I want to thank you for inviting me to join you. Thank you.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.